The gentleman from Ohio, Mr. Gonzalez, is now recognized for 5 minutes.
Thank you, Madam Chair, and thank you to both Chairman Powell and Secretary Yellen for being with us today. Congratulations to Chairman Powell on your reappointment. Secretary Yellen, I'll start with you. Earlier you said, and I think you've said it in different ways a few times, when supply and demand get out of balance, you can have inflation, and the demand side has accelerated while we still have supply chain bottlenecks. Fair?
The demand has been strong. Demand has also shifted away from services and toward goods, which has created huge problems, more than the aggregate level of demand.
Yes, ma'am. And the American Rescue Plan, which was a partisan bill, that juiced supply, or I'm sorry, that increased demand, which you testified to, did it do anything to alleviate supply issues?
It didn't have substantial impacts on supply.
So when we say that, and this is my frustration, for a year plus, we negotiated in good faith bipartisan legislation to be targeted and appropriate with respect to our response to COVID-19. You all won the election. It's your prerogative to ignore Republican concerns. But you went forward with the American Rescue Plan, which we warned would increase inflation, specifically for the reasons the Secretary just said. It would increase demand and do nothing to alleviate supply chain bottlenecks. That's exactly what happened. You're set to repeat the exact same mistake with Build Back Better. Chairman Powell, I want to commend you for retiring the term transitory as it relates to inflation. My constituents have been complaining about it for over a year. Two concerns. One, inflation is particularly hard on low and middle income Americans, in particular those with fixed incomes. We all know that. It's been brutal for them. Two, and I think this is the new risk accumulates over time the longer rates are at zero, as anyone who invests money and discounts cash flows at a zero interest rate can justify virtually any investment. As we've seen that in various asset bubbles have built up over time, so now I think the risk shifts. Now I believe the risk is that we have let inflation run too hot for too long, and we're in need of a more sudden course correction, which you suggested yesterday. That being the case, what are you most concerned with when considering the ramifications of the taper on the market and the economy at large? What pockets of risk are you looking at as the taper begins?
Let me just say, I think that the taper need not be a disruptive event in markets. I don't expect that it will be. It hasn't been so far. We've telegraphed it. I mean, I think if you look at the state of the economy, look at where we are, look at the most recent run of data, you can see that the highly accommodative policy that we have, even after the taper is done, it's really appropriate that we taper. And as I mentioned yesterday, in my view, it's appropriate that we consider at the next meeting tapering faster so that it wraps up a few months earlier.
Yeah, I agree. I guess I would encourage you, and my concern again is we've seen asset bubbles accumulate over the course of the pandemic. Investors have done incredibly well. I think we should be tapering. I agree with Van in a lot of ways on the monetary front. But I suspect that there's risk building up, and I just want to make sure that it's on the Fed's radar. I want to shift to, I have a minute and 26 seconds to see if we get this out. So in recent months, Americans have unfortunately seen energy prices significantly increase, especially at the pump. Some people who talk on Twitter have claimed that this is due to greedy corporations and speculators driving up prices. Do you believe that's the reason for increased gas prices?
So energy is a global market, and there are many, many factors at work there, I would say. It's a combination of very strong demand across the board, and a number of supply-side factors, too.
Not greedy corporations and speculators driving up prices. That's not accurate for why energy prices are high.
You know, looking at this from an economic perspective, it's very strong demand in the face of what have been some supply blockages and a little bit of discipline on the part of the providers.
Thank you. I agree. In the summer of 2020, the Federal Reserve updated its statement of longer-run goals and monetary policy strategy to state that the Fed would seek to achieve inflation above 2% for some time period. Do you have any second thoughts on that, given that we've seen inflation persist for quite some time? And how would, if we didn't change the framework, how would you potentially have responded differently throughout the pandemic?
So The sort of overarching fact of monetary policy in the last 15 years and probably the next 15 years is just that interest rates are significantly closer to the effective to zero. And in that world, it's hard to support the economy and attain growth and maximum employment and 2% inflation. So the framework was designed to address a situation in that. Now, what we have here is a unique historical shock, which is the beginning of the pandemic, the middle of it, and the end of it. And so you have a different situation and we have a different part of the framework that deals with that.
The gentleman's time has
Thank you.
expired.
I'll follow